A slowing but healthy job market in a growing economy, followed by a stubborn inflation that continues to play a losing game. Welcome to RealPage Economy Express. We begin this episode by highlighting the latest report on pending home sales. According to the National Association of Realtors, the index in June grew by just 0.3%. Even though the growth was moderate, it was the first one in 4 months. And let's not forget the fact that the average interest rate for the benchmark 30-year fixed mortgage currently stands at about 7.4%. On an even broader note, the GDP surged by 2.4% in Q2. Consumer spending, which represents over 2/3 of the entire economic activity, rose by 1.6%. This enhanced economic confidence is evident in the latest Consumer Sentiment Index, reaching a 20-month peak in June. And furthermore, according to Atlanta Fed's GDP Now model, the real GDP in the Q3 is expected to grow at an annual rate of 4.1%. Our data reveals a robust lag correlation between gross metro product and occupancy in key markets nationwide, strongly indicating future occupancy growth. Now, the highly awaited report of the past 2 weeks was undoubtedly the employment situation update, and true to expectations, it proved to be far from disappointing. While the job market is showing signs of moderation, characterizing it as weak is nonsense, especially at a time when the economy generates close to 190,000 jobs just in 1 month. In fact, it is still strong enough to potentially pave the way for additional price hikes. As per the Bureau of Labor Statistics, inflation, gouged by the Consumer Price Index, rose 0.2% in July, marking a 3.2% increase over the last year. Now, this figure slightly surpasses June's rate, yet core inflation only rose by 4.7% year over year, marginally lower than June's level. Now, this partly justifies Fed's July rate hike. Now, the good news is that the CPI, excluding housing, showed an average growth rate of around 1%. As we have many times emphasized across various social media platforms, there is a 4-quarter lag between asking rents and CPI rents, implying a potential future decrease in CPI at somewhat faster pace. However, seeing inflation go down to 2% in the short term is very unlikely. So, if employment continues to decline and inflation maintains its downward trajectory, it might be just enough not to see another rate hike from the Fed in September. Evidently, a recession is not in sight, at least for this year. Thanks for watching. We'll see you all in 2 weeks.